If you've been scrolling through the real estate headlines this month, you've probably noticed they read like the script of a Hollywood disaster movie. Predictions of total housing market crash everywhere, leaving local buyers and sellers feeling like they're trying to play a high-stakes game of poker completely blindfolded. Today we're looking past the clickbait to deliver the cold, hard data of what is actually happening right now in California's Inland Empire. We're tracking adjusted sales forecasts, shifting inventory levels, and a surprising trend in foreclosure activity that the mainstream media completely distorts. I'm Jeff Moss with National Realty Group, and let's look at what the numbers mean for your pocketbook. Let's kick things off with the elephant in the room, mortgage rates. Back in late 2025, the experts predicted rates would settle down nicely around 6% by now. Instead, they've thrown us a curveball, throwing on brakes and spiking up towards 6.5%. Because of that spike, the National Association of Realtors just had to trim their sales outlook for the year. The initial forecast predicted existing home sales would surge by a healthy 14%. Now that growth estimate has been slashed down to just 4%. On a macro level, total projected home sales across the country have dropped from 5.2 million to 4.9 million units. Out here in the IE, that means homes are starting to sit on the market a bit longer. Buyers are hitting an affordability wall that feels taller than Mount Rubidoux. Until those rates take a breather, a lot of first-time buyers are going to find renting looking more cost-effective than taking on a new mortgage. Now this brings us to a weird paradox. If sales are slowing down, home prices must be crashing into the dirt, right? Well, not exactly. Despite fewer homes trading hands, median home prices are holding completely steady with a projected 4% increase for the year. And how's that possible? Well, it comes down to basic Econ 101, supply and demand. Even though buyer demand is chilled out due to poor affordability, our local inventory growth is still moving like molasses. Think of it like a game of musical chairs, but half the homeowners down in Corona or Rancho Cucamonga have looked at current interest rates, remembered the 3.5% rate they locked in a few years ago, and decided, they're just going to stay glued to their seats. They'd rather stay put than list their property into a softer market. Because new listings are keeping a low profile, home prices aren't tumbling, they're just moderating at a national level. Now let's get hyper-local, because real estate is entirely about zip codes. If you look at the national pricing map, the Rust Belt is heating up while the Sun Belt is cooling off. Pockets of Texas, Florida, and Colorado are seeing prices soften because their inventory levels actually bounce back above pre-pandemic levels. But check out our neck of the woods. Riverside, California is showing a modest, flat, year-over-year price change of about -%. We are essentially flatlining, not free-falling. But what about the scary news reports screaming that foreclosure activity is rising? It's true that properties with foreclosure filings ticked up roughly 120,000 nationwide in the first quarter. But before you panic and assume it's 2008 all over again, look at this long-term historical chart. Back during the Great Recession, foreclosure filings peaked at over 900,000 in a single quarter. What we're seeing right now isn't a systemic crisis. It's just the market normalizing back to historic baselines after years of pandemic-era foreclosure moratoriums. The truth is, people don't buy or sell houses just because of the decimal point on the Federal Reserve chart. Life happens. People get new jobs, families grow, couples get married, and retirees decide it's finally time to downsize. Over a typical 2-year span, millions of these major life changes happen across the country. And those real-world needs eventually outweigh the financial benefit of clinging to an old mortgage rate. And luckily, current homeowners are sitting on massive financial safety net today. Nearly 40% of all Americans own their home completely free and clear. And out of those who do have a mortgage, more than half are sitting on over 50% equity. Total owner equity in the US is sitting near an all-time high of nearly $34 trillion. That's more than the net worth of Elon Musk. The massive equity cushion means we don't have forced sellers who need to dump their properties at a fire sale discount just to escape. So what's the bottom line for the Inland Empire? If you're a buyer, the frantic bidding wars have cooled, giving you a bit more breathing room to negotiate. If you're a seller, pricing strategy is now absolutely everything. Homes that are priced competitively and present beautifully are still drawing multiple offers. If you want a local team that watches the data like a hawk so you don't get burned, make sure to hit that subscribe button. Drop a comment down below. Are you waiting for these current interest rates, or are you ready to make a move regardless of what the Fed does next? I'm Jeff Moss with National Realty Group, and thanks for hanging out with me today, and I'll catch you next week.